Hi guys, Max here, and this is your daily market update for yesterday, the 25th of February. Now, this video will just be about the finance world, what's going on in the markets, and then later on today, I'll put out a second video talking about the situation in Ukraine, how the war is progressing, and what the new developments from yesterday are. So what actually happened in the markets? Well, by and large, they rallied following what was a very volatile week. The S&P 500 saw a really strong day and rose by over 2%. The Nasdaq actually lagged slightly, but still rose by 1.6%. European stocks as well rallied hard. The Stoxx 600 rose by over 3%, the FTSE 100 was up by 4%, and the DAX rose by 3.5% as well. Even the Russian stock market saw a rally, surprisingly enough, rising 20% yesterday after falling about 40% the day before. The MOEX index is still far below where it was prior to the invasion of Ukraine. Currently, it's down about 32% from where it was just a week ago. So why have markets rallied on what should really be bad news? Well, there are a couple of reasons as usual. The first is that the markets were pricing in things which were not certain. That's what markets do. They try to estimate the likelihood of certain outcomes, and the outcomes that came true were not the worst possible ones, so markets are a little bit more confident. We also have much more certainty right now than we did before. We know that Russia has invaded. There is no wondering if there will be war anymore. We know that NATO will not deploy troops to Ukraine. There is no wondering about whether or not the West will be fighting Russia's. We also know what many of the sanctions that Russia will face are, and they have mostly been announced, and while they will continue to be added to over the coming days and weeks, we know the targets of what we've seen so far, and we can guess what the governments are going to do in the future. We can identify the areas and the industries that our governments are specifically trying to keep exempt and the ones that they are happy to target. Now, what are some examples of this with the sanctions? Well, energy is very specifically not being targeted by pretty much anyone. The US actually came out and said that their sanctions are specifically aimed at impacting Russia's ability to do business, to trade with the world and finance itself, while not spiking energy prices. Now, that's the really important part there, not spiking energy prices. What that really means is oil and gas prices, and the EU have put into place a bunch of sanctions as well, and they are also trying to avoid spiking energy prices. On top of that, some important industries to certain countries have managed to put into place carve-outs to ensure that they aren't going to be impacted. Luxury goods from Italy, for example, is a huge industry for the country, and they export a lot of very expensive high-margin products into Russia, and that should have had a halt put on it with these sanctions, but the Italian government managed to secure a carve-out for that industry to ensure that Russia can still buy their Gucci loafers. Another carve-out that we've seen from the EU was the diamond industry from Belgium, which is specifically excluded so that that industry can continue to profit off of wealthy Russian oligarchs. In general, these sort of actions severely lessen the impact of sanctions, which is counterproductive to what the sanctions actually hope to achieve. It's counterproductive to the situation on the ground in Ukraine as well, but it helps the markets, it helps business, it ensures that money flows, and that's good news for investors and markets like this news. Now, what else do the markets like? Well, the financial sanctions, which actually are quite extensive, are again being specifically chosen to target Russian industry, Russian banks and Russian capital and oligarchs, while specifically minimizing impact on the West. Now again, this does make sense, and it's actually a pretty sensible way to go about it, but of course it does slightly reduce the impact of these sanctions. Hundreds of banks, institutions, companies and people are being targeted, and by some estimates, as much as 80% of the transactions in and out of Russia will be disrupted by these sanctions. The reason markets like this then? Well, because it's not as bad as it could have been. Banning Russia from SWIFT was widely regarded as the nuclear option that would be reserved for if Russia actually invaded. But the invasion came, and no one pressed the big red button, or at least no one pressed it yet. There have actually been some developments on this. At first, resistance to this action was mainly from Germany and Italy. Germany wanted easy access to Russian gas to continue and was worried that this would disrupt that. And Italy wanted business cooperation with Russia to continue and was worried that that would be disrupted as well. As of this morning, though, both countries have indicated they would not block the action anymore after huge amounts of backlash both domestically and abroad against these governments for refusing to take action. Right now, the only country still opposing banning Russia from SWIFT is Hungary, and the US, Canada and the UK are all pushing for it very heavily, so we may see this change over the next few days. But as of right now, the markets are actually quite happy with the financial sanctions that have been revealed. They are confident that they will be able to continue to work through it. Now, what about the rest of the financial world? What happened with bonds, gold, oil, and crypto, for example? Well, risk on assets did well. Risk off assets did a little bit less well, but not awfully. Bonds had seen a major rally recently as investors saw a safe haven from volatility, and that had caused yields to drop, but they have now stabilized and yields have even started to rise a little bit again. The US 10-year Treasury is currently sitting at 1.97%. Gold saw some outflows as well, again, as investors got a little bit more confident about the markets, and so prices fell about 2%, and per ounce, gold is now sitting at about $1,890. Now, this is still very high compared to where it's been recently, and in a similar vein, oil prices had spiked huge amounts on fears that supply shortages would come about as a result of this war in Ukraine, but as earlier stated, sanctions are specifically not targeting energy to keep oil and gas flowing and to keep prices from spiking, so prices have fallen slightly. WTI crude is sitting at about $92 a barrel right now, and Brent crude is sitting at about $98, so both have fallen by 1% or 2%. Again though, as is the same with gold, these prices are still very high. Only a couple of months ago, oil was below $80 a barrel across the board. And then we've seen that the dollar performed well, again, which is a little bit surprising to some people, but the supposed idea is that it is still the world reserve currency. It is still the world's most widely accepted currency, so it's just a little bit more stable than others, and it rose in value by about 1% against most other currencies, and it's up 8% against the ruble compared to where it was just a couple of days ago. Now, the other reason it's performing quite well is because of some news, or not really news, but just some change in market sentiment regarding the Fed and monetary tightening, which we'll talk about in a moment. But first, finally, what happened in the world of crypto? Well, we saw prices mostly stabilize and rise slightly. Of course, everything was so volatile, seeing dips of 20% in some altcoins as the invasion of Ukraine started, followed by equally large gains, and right now, the market is pretty much exactly where it was a week ago. Bitcoin is sitting at $39,000, Ether is sitting close to $2,800, so it's basically like the last week of chaos never happened. Altcoins are similar, by and large they're in the same sort of place. Some are going to be higher and some of course will be lower. Now, the other one huge development that has caused markets to rally, and it is related to Ukraine, but in reality it's all about the Federal Reserve once again. Now, I know we almost went an entire week without having to talk about the dreaded Fed, but not quite. Basically, what's going on here is that because of the chaos in Europe, the war and the fears and everything kicking off, the likelihood of a really strong Fed rate rise has been decreasing according to the markets. Just a couple of weeks ago, the markets thought that a 50 basis point rise of the Fed funds rate was more likely than a 25 basis point rise, but that has now switched once again, and the consensus is that we'll see the lower rate hike next month. Markets, of course, love this. They're terrified of rate hikes. That's been one of the major reasons we've seen so much red in the markets recently. And this is good news for them. However, it is all just a little bit irrational. I know the markets being irrational, well, I never. This is just based on sentiment, basically. People just think that because there is turmoil in politics as a result of the war in Ukraine, that the Fed won't be raising rates by too much, and that might turn out to be the case. But this is such a ridiculously difficult thing to bet on. That's why the market consensus changes so much. We've heard odd bits from people at the Fed maybe indicating this might be the case, but it's not like Jerome Powell came out with a loudspeaker and told us all that monetary tightening is ending, that the US is heading into war production mode or anything like that. This is all speculation, and really, we just need to wait and see what happens. Now that is it for the day, guys. Again, another video will be out later today talking about the war in Ukraine. Watch it if you want to, don't watch it if you don't want to. If you enjoyed this video, then leave a like and a comment to bless the YouTube algorithm. If you want more content like this, then check out our Patreon and join our community of investors. You get access to our Discord, loads of exclusive content like insight into my portfolio and buy and sell alerts for all my own investments. There's a link in the description to masterworks.io, a site that allows you to buy fractional shares of art from world famous artists like Banksy, which can be a great way to diversify your portfolio with non-market correlated assets. It's completely free to sign up, you don't have to buy anything, you don't have to hand over any card information, so if that sounds interesting, then make sure to check it out. There's also a link in the description to BlockFi, which will give you up to $250 in free Bitcoin when you use it. You can also get 9% interest on stablecoins like USDC, which is a far higher rate than you get from any savings account these days. Just make sure not to use Tether. Thank you all for the support, thanks for watching, stay stoic, until next time.